Hi everyone and welcome to Inderes TV. Today we're going to talk about Scanfil with Head of Analyst Antti Viljakainen. Welcome.
Thank you.
What is going on in the market at the moment?
Well, I think that the market as such is good. Incap's profit warning was very much about one customer. They have very big one customer that is scaling down its inventories, and it hits very badly Incap, but it's not like broad issue that has impact on other players on the market as well. Demand has been good. This sector is mostly industrial investment driven, and these companies that are customers of EMS companies have been getting very good orders during the last year, and now they are delivering these orders and asking service from EMS companies. So demand as such is very good, and it's driving companies to good revenues and also to profits this year. But we must remember that this is like a post-cyclical sector. So it remains to be seen what happens
Where we
in
will land.
2024.
Yeah. So, but Scanfil, I mean, the sector has a lot of drivers at the moment, and Scanfil was flagging for, they're usually very accurate in their guidance, but now they're flagging for better results.
Yes.
If you take a look at Scanfil as a company in the beginning, well, how would you put it in a nutshell? What are they doing?
Well, Scanfil is quite a traditional EMS company that is operating with a vertically integrated business model, so that Scanfil can offer all the service from equipment manufacturer, equipment company, from purchasing to after-sales services, including also production and everything in value chain. Scanfil is operating mostly in industrial electronics segment, in which is possible to operate profitable way also to somewhat smaller companies. So this is not like manufacturing iPhones, then you have to have huge scale, but this is Scanfil's business is more like high mix, low volume business.
So a smaller player with the whole chain.
Yeah, exactly.
And the industrial sector. And now flagging for better performance. So what are the drivers behind this one?
Scanfil stated in the stock exchange release that demand is improving in 3 segments out of 5 at the beginning of this year, and the second big driver is of course component availability. These component issues caused a lot of problems for Scanfil. Last year they couldn't manufacture what they were selling because they didn't get components. This was an issue that touched everyone basically in the market. So Scanfil didn't do anything worse than its competitors, but it was just a very difficult situation. Anyway, components are nowadays available much better when supply chains are getting normal after these COVID-related distresses. And these 2 were the major drivers. The third one also. Scanfil has invested a lot in new capacity in its current mills, so they have also more capacity to deliver for the customers.
So there's a growing market and market with tailwinds, and they have had problems with delivering due to the components shortage.
Yeah.
And this is kind of easing it up now.
Yeah. In general, economy is slowing down, and China is open, so supply chains are functioning a bit better than they did.
Yeah.
During COVID times, so it's like easing out from 2 ways same time.
Yeah, and the capacity is also now.
Yeah, capacity is also higher, so they can deliver what the customers are asking.
Yeah. And what about the customers? Who are they really? They're divided into 5 segments, but you said that's not that important, but who are they really?
Well, you can find a quite good list of reference customers in Scanfil's investor presentations. But they are like industrial equipment manufacturers. I could say that majority of Scanfil's customers are like Nordic technology companies, Kone, Vaisala, Valmet,
Pretty big names
Toyota
there.
Material Handling, and so on. Yeah. They are big listed companies that use electronic manufacturing services companies, so that they don't have to invest in production capacity that much. It of course helps them to keep cost structure flexible, and also they don't have to tie up capital in mills and factories as they buy production as a service. That's why these big companies use electronic manufacturing services like Scanfil to make their products or part of products.
But what about, we talked about Incap earlier on, they had a really big customers affecting the whole business. What about the concentration of the customers in this case?
If I remember correctly, Scanfil's biggest customers, which is Kone, I guess, I don't know, I guess.
You don't know, but you guess. It's a qualified,
I do.
qualified guess. Yeah.
Brought some 19% of Scanfil's revenue last year. And the other biggest customers didn't go about 10% of group revenue. So it's much more
diversified
than Incap's portfolio. I would say that Scanfil's portfolio is quite typical in this industry. I think that 10 biggest customers bring some 50% of Scanfil's revenue, which is quite common in this industry. It's also very difficult to operate production if you have very many very small customers. So it tends to be so that there are some concentration, and some concentration is also good for profitability, I think.
Yeah, concentration, but not too much, because I'm thinking about the sites as well. If you have to change everything for every customer, it wouldn't be efficient to have too many.
Exactly.
But what about 19%? I looked the numbers as well. So that's the biggest one, and you think it's Kone?
Yes.
Yeah. So in this business, you should really actually follow what the customer companies are doing and what kind of cycles they are moving in.
That's right. That Scanfil does as well as its customers do.
Yeah, and interesting to follow. But what about these financial targets? Because we talked about no, we didn't talk about it, but 7% of EBIT margin, that was one of the financial targets.
Yeah.
Do you think it's possible now with higher guidance?
Well, if we calculate from the guidance, top line guidance and EBIT guidance, what the margins would be, it states that Scanfil will go somewhere between 6 and 7 this year. So it's already quite close to 7% target. Scanfil has gone above 7% during the last decade, at the beginning of decade, before this big partner tech acquisition. So they have really demonstrated that it's very, very reachable. Also, Scanfil was very close of that target before pandemic. So I think that's very, very realistic for Scanfil, and my current estimates are basically at the target level.
So what do you think about the revenue? Because I read your latest comment from February, and then you had for kind of a longer period of time that it would be a drop at least 23 and 24.
We must remember that Scanfil made a lot of spot market purchases last year.
Which means?
Which means basically that they bought components from the spot market, components logistics from the spot market, so that they could deliver for customers. This is not usual business.
So they are kind of stacking up.
Yeah, they were stacking up, and these spot market purchases basically didn't get any profit, so it was like zero margin business. And of course, the company under normal circumstances will not continue this kind of business. If I remember correctly, it was like 80 million euros last year. Yeah. So I am estimating that this 80 million euros will mostly fade away this year and completely during the next year. And this, of course, dilutes significantly Scanfil's reported revenue growth when the base year is 2022. So I am actually estimating that Scanfil is growing organically.
Okay, but this is a good explanation to the long term. Yeah, okay.
Yeah. This year, well above, I would say maybe 5 to 10%, and also slight growth during the next years.
Okay, so if we look at the valuation at the moment, could you comment on the valuation in the sector to begin with?
Yeah, valuations in EMS sector have been usually quite low. I mean, well below stock exchange averages. We are talking about some 10 to 12 PE multiple in the long run. This sector has been valued quite low as it's like thought difficult subcontracting business in which customers always pressure your profit margin. But well, I wouldn't say that this is actually so true nowadays.
Yeah, so what's the case really here? Are they all kind of cheap or not, or are just bombs waiting to explode, or how should you look at the market?
I wouldn't expect any fast changes in valuation pictures, but in the long run, I see that there is some valuation potential if and when these companies in this sector can generate reasonable growth and stable profits, which I believe they can do. Yeah, so definitely more upside than downside in valuations in the long run. Scanfil is trading now with updated estimates at some 13 PE multiple for this year, and the same for next year. This is basically at the level of Scanfil's 5-year median. So valuation as such is quite decent, but of course the share price has increased some 40% from the beginning of the year. So it's not also very cheap any longer at my current estimates, which are basically in the middle of the guidance rates. So I would say that Scanfil at this stage is quite fairly valued, looking 12 months forward.
Okay.
But in the long run, I'm very confident about Scanfil's investment case. They have been doing a great job during the last decade, and I see no reason why they couldn't continue this profit growth also during the next decade. And of course, if profits go, stock price tend to go up.
Yeah, and would you position them as looking at quality about the peers, would you state them as a higher quality against the others? Or?
No, well, if we look at the long-term track record, I would say that Scanfil has done a bit better than its peers during the long run. So I would say that they would deserve a slight premium to peer group in terms of valuation.
Because there are a lot of peers.
Yeah, there are available. But at the same time, I have to say that the whole sector has improved a lot during the last decade. At the beginning of the last decade, Scanfil used to be star of the sector, and many companies were struggling badly. So it's like much more even game nowadays.
Okay, so they have the quality in hindsight, but also other potential peers are coming up to the same level.
Yes, and some companies have also done higher margins and faster growth than Scanfil during last, let's say, 3 years.
Yeah, true. So what about the recommendation at the moment?
Today, I changed recommendation from accumulate to reduce due to valuation. Valuation reaching quite neutral level, in my opinion, for the next 12 months. Of course, this profit warning caused a major estimate revision upwards, so I increased also target price to €9 from 8.25. So as I said, it looks quite neutral, not cheap, not expensive. Looking 12 months forward, but in the long run, Scanfil offers very interesting investment story, in my opinion.
Interesting, not cheap, not expensive. Good to end there. Thank you very much for all these comments.
Thank you.
Bye.